Hello and a great welcome. So, hope each one of you, as always, are absolutely fine, and we also pray to the Almighty to keep you absolutely safe, sound, and healthy. So, on such note, we start today a very significant topic accounting for financial instruments. It's a very significant topic, and each one of you are very well aware of this particular fact that there are three Ind ASs which deal with what we call accounting treatment of what we call financial instruments. Of course, Ind AS 109 and Ind AS 107, besides Ind AS 32, these are the what we call standards which deal and govern the what we call entire accounting, what we call scenario of this particular chapter, and of course the guidance with respect to this particular chapter. However, at the same time, the difficult part is that actually it is very difficult to do Ind AS 109, 107, and 32 separately because these standards are so deeply intermingled with each other that it is very difficult to actually analyze them separately. So that's why we have to what we call collaboratively use them for discussing the what we call accounting aspects of financial instruments. Point here is to be noted is that when we are doing accounting for financial instruments, it automatically means we are also doing these three standards simultaneously. And it's a very significant, formidable chapter, no doubt about that. I need not require to actually remind you time and again. This chapter is important on two counts, one from examination, and at the same time, when later on you are going to enter into your practical arena over there, actually, you will have to confront many such issues which are related to financial instruments. So on that count also, you need to actually focus very hard to grab the what we call intricacies of this particular chapter. So that should work as a motivating what we call factor for you to pay what we call extra attention towards this particular chapter. So here we go and start this session. Correct? Just a moment ago, I told you as far as this particular standard is concerned, or this particular chapter is concerned, correct? There are three standards which are simultaneously dealing up with this particular chapter. So we may say that accounting for financial instrument is covered, you write along with me, covered under. This chapter is covered under, as I said a moment ago, Ind AS 109, Ind AS 109, Ind AS 109. In fact, Ind AS 109 deals with the recognition and the measurement part. It deals with recognition and measurement part. And measurement part. With respect to financial instruments, of course, I need not require to talk about that. Then similarly, Ind AS 32. Ind AS 32, in fact, it deals with presentational part. Presentational part. Presentation. All these three standards I have already told you are so intermingled that it is very difficult to do them separately or in a segregative manner. So that is why, as I told you, we have to use collaboratively what we call these standards to discuss the issues which are pertaining to the accounting for financial instruments. Besides that, we have another standard that is Ind AS 107, which takes care of the disclosure aspect of this particular chapter, disclosure aspect. So these are the standard which, as I've already told you, provides what we call guiding lights with respect to the accounting for financial instruments. It's a sort of new topic for us because most of the topics which we have covered under, or should I say, at this level, some of the basic part we have had already been aware of, but this is not the case with respect to financial instruments. So that is why it is considered as a tougher part. So quite obviously, one need to pay extra attention to grab the things. Because we are doing financial instrument, quite obviously, first of all, we need to know what exactly the financial instrument is. So what exactly the financial instrument is, let's have a look first of all. Point number one, financial instruments. This is the term we are going to use so often during this particular chapter, financial instrument, financial instruments. And I will use short form FI. So lots of short forms will have to be used. So take care of that particular aspect. Correct. So what exactly the financial instrument is? Standard is very clear about that. Financial instrument simply refers to any sort of contract which gives rise to an asset for one entity, but simultaneously it also takes birth to financial liability for the another, what we call entity. Correct? That is financial instrument. What is a financial instrument? Any contract, correct, which is giving rise to financial asset for one party and financial liability for the another party. How it is possible, I will definitely let you know. So first let me write what is financial instrument. Financial instrument, FI, is any contract, as I said, is any contract that gives rise, that gives rise to a financial liability. We will use the term FL for the same. I have already told you lots of short forms will have to be used. Financial, that gives rise to financial asset. In fact, first let me write that gives rise to financial asset, and we will use the short form FA. Please don't confuse FA in this chapter with fixed asset. Wherever I am going to put an acronym FA, you need to connote it with what we call financial asset, not with fixed asset. So financial instrument is any contract that gives rise to what we call financial asset to one party or of one entity, better to write, of one entity, and and a financial liability and a financial liability for financial liability or equity instrument or equity instrument. It gives rise to two things, either financial asset for one party or financial liability or equity instruments to other party. Equity instruments of another entity. I will explain it. How is it possible? Don't worry about that. Lots of examples we are going to take. Another entity. Just to understand this matter, correct? Let us say it is not exactly case study, it is just an example, but I have a writing of uh, case, correct? Just to keep the sequence intact. Let us say there is an entity. Okay, let us say Mr. F. Mr. F, correct, purchased. Mr. F purchased debentures, debentures of TQM Limited. This is a sort of contract. Why it is a contract? When I am what we call buying debenture of a particular entity, that when there is an implied contract that and I will pay the amount of debenture to the entity. An entity is also supposed to pay me interest, and after a particular specific period of time, should repay the principal amount to me. That is the contract. So it is a contract which is giving rise to. So in this case, we can see it is giving rise to financial asset because Mr. F is the investor. So it's an asset for it. And similarly, TQM Limited has collected cash from us. So it is a liability for it because it will have to ultimately discharge it after a particular point of time. Correct? So that is why financial instrument, it is said, is a contract. Correct? Which gives birth to financial asset for one party and financial instrument for other party. But I also mentioned which gives rise to financial asset or financial liability or equity instrument. For example, let us say case 2. Case 2, if I pick up, let us say Mr. G acquired, Mr. G acquired 5,000 shares 5,000 shares of rupees 100 each of FX Limited. Let us say a transaction takes place like this one. So this time Mr. G is the investor. G has acquired equity shares, and on the other hand, FX Limited is the issuer and it has issued equity share capital. Of course, from the perspective of Mr. G, it will be considered as fixed. It will be considered as financial asset, and from the perspective of the what we call this particular entity, it will be considered as equity instrument. It will not be considered as financial liability. Reason being is that when an entity issues equity share, it is not an obligation to repay the amount. Correct? So it is an equity instrument for what we call this particular entity. So now this particular term which we wrote should be absolutely clearer to you. So it means this entire particular chapter revolves around two axes. One, financial asset, and another one is financial liability. Of course, whenever I will use the term financial liability, simultaneously it will also encompass equity instrument. So you can say it revolves around three aspects, that is financial asset, financial liability, and equity instrument. So one need to be absolutely deft, correct, with respect to the definition, unless and until you will be very clear about what exactly the financial assets are, financial liabilities are, at the same time what exactly the equity instruments are. This particular chapter will become absolutely difficult to grab. Correct? So that's why one need to have a very, very good idea regarding the financial asset. In fact, I have seen actually many a student and many others actually, correct, get confused what exactly with respect to financial, what exactly financial assets are. So that is why I am cautioning you in the beginning itself. So now I write here, next point is financial asset. Financial assets. So now we will look at what exactly the financial assets are, FA. Correct? Because most of us are acclimatized to use FA for fixed assets. So one need to be careful that in this entire length and breadth of the what we call chapter, FA shall stand for financial asset. What exactly the financial assets are, let's have a look. And later on we will have lots of examples on it too. A financial asset. A financial asset. Okay, I will write in full at this moment. A financial asset is any asset, is any asset that is, this is not my definition, this is the definition of the standard. A financial asset is any asset that is, now some what we got points have been given. This is sheet number 1 for me. I will have to use the sheets also, sheet numbering also, correct? So standard has provided a broader list. A, a financial asset is any asset that is, 1, cash. Cash. Cash is considered as a financial asset. A deposit of cash, a deposit of cash with a bank or any financial institution or any financial institution or any financial institution is a financial asset, is a financial asset as it represents, as it represents contractual right, it represents contractual right to receive or to obtain. There's a difference between receive and obtain. Obtain means we have the right to take it back. Contractual right to obtain what we call cash from the bank. If I have deposited cash in bank, I have every right to claim that cash. Correct? Obtain cash from bank. So it represents a contractual right to obtain a cash from bank. So it is a financial asset. Similarly, B extended further says an equity instruments of another entity. An equity instrument. An equity instrument. EI. I will use the short form EI henceforth. Lots of short forms shall be used. An equity instruments of another entity. Of another entity. As I gave you the example earlier, when we invest in another entity, it gives rise to financial asset for the party investing, and for the entity, it is an equity instrument. Correct? So, an equity instruments of another party, because if I have invested somewhere else, then I have the contractual right to take the cash against the same. And similarly, for other party, it's an equity instrument. It is not a liability, but it is an equity instrument. Similarly, then I will simply write example investment in equity shares. Investments in equity shares. Investments in equity shares. Correct? Then C. Financial asset is cash, an equity instrument, and it is any asset that is a contractual right. When you have a contractual right to receive cash or another financial asset, another financial asset, another financial asset from other entity, from other entity. In that case, it will be considered as financial asset. For example, suppose suppose I sold goods to somebody on credit. So that is trade receivable. That means I have a contractual right to take what we call either the cash from the other party, or what we call either to take cash from the other party or what we call some other financial asset in settlement. Similarly, loans. Suppose I have given loans to somebody, then I have the contractual right to receive against the same cash or other financial asset. Correct? Similarly, advances. If I have given some advance to somebody, so all these are examples of contractual right to receive cash or another financial asset. So all these will be considered as financial assets. A contractual right a contractual right to exchange a contractual right to exchange financial asset or financial liability. When you have a right to exchange financial asset or financial liability with another entity, with another entity, with another entity conditions under conditions that are potentially favorable, potentially favorable. It is a little bit tough to understand. Potentially favorable. PF, potentially favorable to an entity. You have a contractual right to exchange financial asset or financial liability under the conditions which will favor you. What does it mean? I will explain it, of course, as usual. Let us say, okay, in order to explain, let me stretch a line first of all. Let us say on 1/4/2021, I enter into a contract, correct? I enter into a contract that I enter into a contract with somebody that I will purchase at the rate of rupees 100. This contract has been established on this particular date. Let us say a contract on this particular date, correct, took place between I and other party, that I am going to buy what we call 100 shares from that party, but I will buy these shares at the rate of 100 each. I will buy 1000 shares, okay. I will buy 1000 share at the rate of 100 each, but I will buy it, let us say, on 31st of August, 31st of August 21, after some time, correct? I will buy the share at the rate of 100. This is the contract. Now try to understand. This is the settlement date. Now let us say on this date, if of this share, market price of these shares is, let us say, 150. In market, the price of these shares is 150, but as per the contract, I can buy what we call these shares from this value at the rate of 100 only. So it means I have a contractual right because of the contract, correct? And these are the conditions which are favorable to me. Are you getting my point or not? So even such sort of contract or such sort of contractual right, correct, are considered as I told you, what we call financial asset. This is the point which you need to understand. So this is a condition which is potentially favorable to you, because you can buy these share at the rate of 100 and you can sell them in the market at the rate of 150, isn't it or not? So you must understand this also. Sheet number 2, I think it is. Okay. So after having a look over contractual rights, correct? I hope you got a bit of idea, or you want me to explain it further? You want me to explain it further? Okay, I will have to think of a case study then. Uh, okay, right. F4, F4 Limited, F4 Limited holds a call option. A call option, this is a term which you should be familiar up with under, and you have gone through such terms so many times in your financial management paper and SFM paper. Correct? F4 Limited holds a call option purchase purchase equity shares to purchase equity shares in a listed company that is G77 limited for rupees 50 per share. Contract is that I can buy the share at the rate of rupees 50 per share at the end of, and as per the contract, it is also written that I will buy the share at the end of 60 days, but I will buy it at the rate of 50, 60 days, at the end of 60 days period. If value of share on exercise or settlement date, that is after 60 days. If value of shares on exercise or settlement date is more than rupees 50, more than rupees 50, then it is beneficial for me, correct? Then it is a potentially favorable condition. Potentially favorable condition. I hope now you must have got it. Favorable condition. Same thing, but in a statement manner. Correct? Cash, we have seen. Equity instruments, we have seen. Contractual rights, we have seen. Isn't it or not? Now, sorry, this is, I think, E. So now we will see that financial asset is any asset that is a contract that will that will or maybe that will or may be settled in entities own equity instruments. Equity own equities instruments. A contract that will or may be settled in entities own equity instruments and for which and for which and for which it is clumsy, for which entity is entity is or may be obliged to receive a variable number of entities own equity instruments. Very difficult to grasp. It's a pretty advanced level point. Correct? But you need not require to worry. We are here. I'll put up a case, then you will be able to understand. Case 4. Try to have a look over here. Let us say there is an entity. There is an entity, there are lots of pen lying here, by the name of E1. We presume that this entity sells a plot of land, sells a plot of land to, to let us say Mr. S, who is who is also a shareholder of E1. Are you getting my point or not? E1 is selling the plot to what? To a person who is also a shareholder of the entity. Now, this shareholder says that, well, I will pay the consideration, and there is a mutually agreed contract, let us say, between E1 and this shareholder for this transaction. So E1 tells that he will settle the consideration, settle the through consideration through consideration through equity instruments. Whenever I am writing equity instrument, you consider them equity share capital till the time I will explain the correct meaning. Settle the consideration through equity instruments of the entity held by him, because he is shareholder of this entity. So this shareholder is having shares of this particular entity, and he tells to this entity that, well, I'm going to actually settle the consideration by way of shares which you have issued to me. Because it is a contract, so entity is obliged here. Entity cannot say no, we will not accept it. The entity is obliged here to receive these equity shares. Are you getting my point or not? So even such sort of contract, correct, are considered as financial asset. It is very important. So it is pretty what we call on the tougher side, this particular part. So once you have gone through the what we call definition of financial asset, quite obviously now the time is to take up what we call financial liability. Financial liability. Financial liability. What exactly the financial liability are then? Just opposite of financial asset, no doubt about that. Financial liability. Financial liability is a financial instrument, is a financial instrument that is that is a a contractual obligation, that is a contractual obligation. In case of financial asset, we write contractual right to receive cash or financial asset. In case of financial liability, we will write a contractual obligation, of course, to settle what we call cash, or what we call financial asset. A contractual obligation to deliver cash or financial asset to another entity. To another entity. So we are under an obligation to deliver either cash or financial asset. Correct? That means to settle the liability. Example, trade payables. So trade payable, you must have received some goods, correct? So you are now supposed to give them, deliver them cash or some financial asset to settle the same. Similarly, loans raised, etc. Okay, this sheet is also coming to an end. Lots of sheets are lying here. Sheet number 4. Now, financial liability B. I write a contractual obligation, a contractual obligation it is a contractual obligation to exchange financial asset or financial liability with another entity with another entity with another entity. It is similar to financial asset, but over there we wrote under potentially favorable condition. Here we will write the opposite. A contractual obligation to exchange financial asset or financial liability with another entity under terms that are potentially unfavorable. Potentially unfavorable. You have the obligation, you cannot say no. Potentially unfavorable. Even though these are unfavorable condition, but you cannot backtrack. That is, there is an obligation, so that is why it is a liability. Correct? Unfavorable. Just to clarify the point, correct? If the entity, if the entity is a writer, is a writer of a call option of a contract, you can say call option, and prices are favorable, prices are favorable to the holder, to the holder of the option, that means to the other party of the contract, to the holder of the option. So as per this contract, you are the writer and the other person is holder of the option. So even though these are unfavorable condition for you, but since you are the writer of the contract, then you have no option. Correct? Holder of the option. I will still write. As such, as such, holder of option, holder of holder of option means holder of the contract. Options will exercise, will exercise will exercise the options and writer, as I said, writer has an obligation. You cannot say no. Writer has an obligation to settle the contract, to settle the contract. So even though conditions are unfavorable, but they are under an obligation to settle the contract. So such what we call contracts are also considered as financial instrument and financial liability. They are considered. C. That is any financial instrument that is a contract, that is a contract that will that will or maybe similar to the last one which we wrote under financial asset, or maybe settled, that will or may be settled in entities own equity instruments and entity is or may be obliged to deliver a variable number of equity instruments, variable number of equity instruments. In case of financial asset, entity was under an obligation to receive its own equity share. Here we are under an obligation to give the what we call variable number of equity share when it is possible. Just have a look. Just have a look over here. Suppose E1 Limited, E1 Limited has issued convertible debentures, issued convertible debentures, write in bracket, to be converted into equity, to be converted into equity share capital. So this entity has issued convertible debentures that after some time you can get them what we call converted into equity instruments, correct? So obviously E1 has issued these debentures to the investors. Now here, when these investors will convert, entity is obliged to give them what we call equity instruments. Are you getting my point or not? Whenever investor will get them converted, then entity cannot simply say no because it is a contract. That is the point you want to, that is the point actually which I want you to understand, correct? So these are the things which we are going to cover under financial liability. So this is the first part, correct? Then in the upcoming session, we will discuss, as obviously, many more issues. This it's a pretty long, what we call chapter because three standards we are doing simultaneously.